Are we seeing real signs of a recession? In the first quarter of 2022, there was a decrease in the gross domestic product at an annual rate of 1.6%. And things did not look up in the second quarter either, as the GDP shrank by 0.9%. By definition, this should be a flashing red indicator of an economic recession in the US. However, common indicators like economic activity and the labor market show us a much more positive picture. In spite of all this, it is hard to ignore the negatives, like inflation, which peaked at 9.1% in June, the fastest increase since the early 1980s. Now, by September, we know it eased down to 8.2%, but it's still a percentage that is considered to be negative news. Also, consumer prices have skyrocketed. The price of food, housing, and energy prices have essentially doubled. And this has led to the Federal Reserve increasing interest rates by another 75 points. Winter is coming, and Jon Snow is knee-deep in a cold Airbnb market. So are you recession ready? In this video, we are going to look at some of the ways you can prepare yourself for an economic apocalypse. What's up? It's Brian here, bringing you well-researched information on business, finance, and investments. Take a second to like and subscribe below, and watch to the end. There's some good info in this video. Now, there's been large-scale layoffs in the tech space recently. Meta, or Facebook, has let go of 13% of its 87,000 employees this week. That's roughly 11,000 people dropped by Facebook. Now, this is said to be part of the company's first major budget cut since it was founded in 2004. Twitter also got a sharp cut when 50% of its employees were laid off without prior notice. And if that wasn't bad enough, Snapchat is also projected to cut 20% of its workforce. Now, companies are making major decisions in an effort to scale back and cut their expenses in this bad economy. Tens of thousands of people are now recently unemployed. And if you are a worker in the tech industry, this is unpleasant news. A lot of you may need to prepare for potential job loss. Many economists predict that the economy will continue to cool down into 2023, which means these job cuts are likely in a broad range of industries. So this is something you guys need to prepare for. Really, it's time to tackle your debt and get a few months of savings ready. I know this is something I talk about even when the economy is good, but it's even more important when things aren't going so well. Now, interest rates are climbing, and paying off debt, especially variable or high interest debt, could potentially benefit you greatly. The average credit card rate is 18.94%. So carrying debt on a credit card is now more expensive than ever. The latest announcement by the Federal Reserve is they are increasing interest rates yet again for the fourth time this year. This is causing a lot of variable rate loans to rise at an alarming pace. So really, now is a good time to organize your debt and really work on paying down your highest interest rate debt first. And one of the big things people never consider is you can actually negotiate with your credit lender for a lower interest rate. You can also consider debt consolidation. Now, debt consolidation is when you roll multiple high-interest debts into a single payment at a lower interest rate. You may already be pre-approved with a type of debt consolidation that you're not even aware of, and that's moving high-interest credit card debt to a new credit card that just gives you 0% interest for a year. Just by doing that, you might be able to save yourself thousands in interest over the next 12 months and could really serve as a lifeline during the worst of the recession. Okay, so let's talk about another way to prepare for a recession, and that's cutting back on spending. Living within your means is crucial in times of rising costs. Your budget will look very different today than it did 2 years ago because of the inflation we've been seeing. So here is one of the systems I sometimes recommend for budgeting. Now, there are many methods you can use to stick to a budget, and this is just one of them. You can use the 50-30-20 system, which has a basic rule. What you do is you divide your monthly after-tax income into 3 parts. 50% is used for your basic needs like food and housing. Then 30% can be used towards wants and entertainment, and this should include eating out and those random gas station items. And then 20% should be put towards saving or past debt. Now, we don't know when the recession will end, but we can look at the time frames of past recessions to compare. An example would be 18 months, like what we experienced during the Great Recession in 2007. We can also assume it will likely last longer than the 2-month pandemic-induced recession we had in 2020. And that's simply because we don't have the same quantitative easing coming from the central bank. So even if you worked out a budgeting plan a year ago, you may need a new one to keep your expenses in check and increase how much you save. For business owners, your monthly budget would have to be revised, adjusted, and tightened. Identify areas where you can hold back spending without affecting your bottom line, for example, travel expenses. Now, let's talk about personal savings and where you're at with that, and a new way to approach it. It's recommended to have at least 3 to 6 months worth of savings in your emergency fund. And thanks to inflation, the amount of money you spend on bills last year is not the same as what you spend this year. So let's assume you spend $6,000 a month on bills, and you will need $18,000 in the bank for a 3-month emergency fund. Now let's say that you have $12,000 saved up. If you can cut your monthly expenses from $6,000 to $4,000 a month during an emergency, all of a sudden you have that 3 months of savings. So you can create an alternative emergency budget that eliminates your entertainment budget and calculates your necessities based on minimums. The tough part is adhering to that minimum budget. It's a lifestyle change. Now, racking up thousands of dollars in your savings account isn't easy. To stay consistent, you can opt for automatic deposits, so an amount of money is automatically transferred from your current account to your emergency fund or savings account with each paycheck. Also, emergency funds are not limited to 3 to 6 months. You can decide to save up for a year of living expenses. I'd also recommend having a good portion of that savings invested in index funds or bonds. You still want that money working for you. Now, in its early November meeting, the Federal Reserve raised its target for the federal funds rate for the 6th time this year, setting its sights on 4%. This means it will cost more to borrow money, but your savings account might begin to see an annual percentage yield rate increase. If you haven't started saving, take advantage of a high-yield savings account to increase your cash reserve. This will help you face future hardships that might occur due to continually increased prices in consumer goods. Now, people with enough cash are in a better position to invest when the opportunity arises to improve their finances. As Warren Buffett once said, "A market downturn doesn't bother us. It is an opportunity to increase our ownership of great companies with great management at good prices." The market can be quite volatile, yet it has a history of triumphing over inflation in the long run. Now, staying alert for reliable news on the stock market will save you from buying the wrong stocks and losing a good amount of money. We don't want that. We want ways to increase our wealth. Now, this buzz that we have of the bear market and its nature are a little bit different than others in recent past. The downturn is attributed to the Fed's deliberate squeezing of monetary policy rather than an economic crisis. While others question whether the bear market has hit bottom, investors are encouraged to be patient. The US stock market is experiencing a decline. Stocks went lower after the results of the midterm elections. And a crypto sell-off took a dramatic turn when crypto exchange Binance backed out of its plans to buy its rival FTX. The decision brought the price of Bitcoin to a bear market low. Disney spearheaded the decline when it fell by 13.2%. And the S&P 500 followed suit by dropping another 2%. It was closely marked by the Nasdaq Composite, which shed 2.48%, and the Dow Jones Industrial Average, which also fell 646 points. These numbers may look scary, but investing at this time could bring some solid benefits, as I already mentioned. Companies are cutting back and laying off their employees. It is better to prepare by saving cash while the employment rate is still high. So something you need to keep in mind is you need to avoid panicking, and it's the long-term investor that usually wins. Selling your investments prematurely to get cash is risky. If you are in doubt about the stock market, a better strategy would be to identify well-positioned investments that are recession-proof and shift into them. Consider keeping your portfolio in cash or liquid securities. For example, a money market fund is a smart move. Seek out quality assets that can withstand any economic weather and invest in those. Also consider high recurring revenue companies, such as those with subscription-based models, because those generally aren't affected as much by economic downturns. Growth stocks represent companies that are growing the price of their shares, revenue, or cash flow at a faster pace than the market at large. But be careful with these when the interest rates are really high. They have a difficult time borrowing money at good interest rates to grow quickly. The downside is that they are prone to more risk and volatility in the market than value stocks. Some people say you may want to avoid these during a recession. Now, your best bet would probably be dividends or income-producing stocks. Another type of stock you can invest in is dividend stocks. They provide two types of returns and have been known to outperform the S&P 500 without being too volatile. As a new investor who is wary about going all out into the world of investing, you can dip your toe into the lower risk investments. The returns of dividend stocks add up over time from two sources: capital appreciation of stock prices and regular income from dividend payments. If you have been wondering if you can make more cash from bonds, the answer is a resounding yes. Another good choice for those who would like to remain in the safe part of the market. If you want an idea of how bonds work, imagine your family asking you to invest a certain amount of cash and promising to pay back your investment with interest over a specific period of time. Now, to make money on bonds, you usually need to hold them for a little while. Normally, you wait until their maturity date so you can collect interest on them. Now, one thing I would say is try to stay away from constantly obsessing over your investment portfolio anytime there's movement in the stock market. You will constantly panic and be on edge. You don't want to be making emotional decisions when it comes to your investments. The Great Recession of 2008 left businesses in turmoil. Preparing for another economic shock is not limited to your personal lives. Now, a business or side hustle can help support your family in difficult times. Make your side hustle or business recession-proof by thinking ahead of your competitors. You need to think how you can retain your previous customers. You might have to make some tough choices and cut some business or personal expenses during a recession, but you can still make it happen. But it's possible to do this and still maintain your reputation. Now, if you have been doing the things I mentioned, stay focused on doing them. If you haven't, I will just say it doesn't hurt to be prepared. Even if all these things turn around for the better, these are some good personal financial habits. All that being said, how soon do you think the recession will happen? And do you believe we are already in one? Let me know your answers in the comments section, like and subscribe below, and don't forget to check out this video about our economy.